Okay, so John's electronic adjusted account information listed in alphabetical order for the month ended April 30th, 2017. So these are our adjusted trial balance. A physical count on April 30th, 2017 revealed a merchandise inventory balance actually on hand of 2460. Now, I'm just going to quickly remind you, it says our merchandise is 5700, but then it tells us we counted 2460. The reason that is because we don't do any transactions to reflect changes in inventory during the period. We always do an adjusting entry at the end. So we will adjust down to this 2460. We will adjust, but for now, it still reads with what it opened at. So we know the opening balance is 5700, and we know that the closing balance is 2460. Wants us to calculate the net sales and calculate the cost of goods sold. So let's just quickly do our sales. So we had sales of 33,700, and we can less our sales, returns, and allowances. Is there a sales discounts here anywhere?
No.
No. So, and that's fine. Some companies just don't offer a discount for early payment or don't do sales, like a sale as in promotion. So we can just take that 1740 and our sales less our sales, returns, and allowances, and if there was a sales discount, provides us our net sales, which is 31,960, I think.
Yes.
So that is pretty easy to determine net sales. Does everyone kind of know the difference between the word gross and net, gross sales and net sales?
Yeah.
Same as if you have a paycheck, you have your gross wage and you have your net wage or your salary. So your gross is what you get paid on the top, and your net is what's left behind after all your taxes.
Yeah.
It's the same for when you look at your sales and your purchases. Your gross is what you start with, and your net is what remains after you reduce all the things you got to take off of it. So now we want to know the cost of goods sold. So let's go ahead and start this. By the way, you're going to see cost of goods sold referred to as COGS or COGS quite a lot. That's totally fine if you want to use COGS, cost of goods sold. It's very common. So we have our cost of goods sold. And then we are going to have our merchandise inventory. I'm actually just going to use this whole area, so I'll just cross. That was merchandise inventory. And that our opening balance, is 5,700. We then are going to take our purchases. Our purchases were 16,140. We then left our two contra purchase accounts here, our purchase discounts and our purchase returns and allowances. those are for 28 and 110, so we can. And that gets us to our net purchases. So we start with our opening balance, then we determine our net purchases. Now we're going to add in our other cost of goods sold specific cost. So in this scenario, we have a transportation in cost. Transportation in, and that is 380. To get us our total cost of goods purchased. Now we can add up our opening balance plus our cost of goods purchased. Sorry? Yeah, sorry. So we've got a cost of goods purchased of 16,382. And our total, when we add our opening balance to our cost of goods purchased, is our cost of goods available for sale. $22,082. So the way you can look at this, the cost of goods available for sale. So you had an opening balance of $5,700, and you bought a bunch of stuff. You returned some, and you got some discounts. So you took the net of that, and then you also had to pay for the expenses to get it available for sale. Remember, all of that goes into the balance of your inventory. So between all of your purchases, your net purchases, and the balance that you started the year with, or the period with, you had that much to sell throughout the entire period. Okay? So they purchased 16,382. That's the purchased amount, cost of goods purchased. And you had 5,700 to start, so that's your total available for sale in that period, 22,082. Now, we can less our merchandise inventory closing balance, which is 22,460. And we get our cost of goods sold. So I don't have a calculator handy. 22,082 minus 2,460. 19,622. We get 19,622 as our cost of goods sold. So if you were to kind of think of it like a T-chart, here, I'll give everyone a sec to copy it out. If you were to think of it kind of like a T-chart, just really, really, really simply, if you had your inventory, you started with 5,700, you added 16,382, right? That's what you added. This is the net amount, but after we'd figured all that, you added 16,382. Then we did a count and said there's only 2,460 left to determine how to go from this to this. You would credit 19,622. And when you credited your inventory 19,622, you would debit your cost of goods sold. That would be the journal entry that you made. Right? So you started with this, you end with this, and first you added that amount, and then you determined that you sold that amount. Right? So this number we just determined from what you had and what you finished with. What you had, what you added to it, and then what you finished with gives us our adjusting entry. So let's prepare an income statement, which is a multi-step income statement. The first part is going to be very easy. It's going to be more about just the layout for this. So we have a John's Electronics. Of an income statement. It's for month ended April 30th, 2017. So we have our sales, and we had those that we're going to put those, and we're just going to follow along. So 33,700. We need to less our sales, returns, and allowances. And it gets our net. So this, if it feels like we're copying out what we just did, we are. And we get our net sales. Oops. Of 31,960. And now we can start working on our cost of goods sold section. Starts with our merchandise, inventory, opening balance of 5,700. We then we then add our purchases. Of 16,140. Then going to reduce our purchase discounts and our purchases, returns, and allowances. 28, and 110, which gets us 138, which gets us our net purchases. Which is 16,002. We're adding in our cost that got the inventory ready for sale, which was our transportation. Which then provide us our cost of goods purchased. Which then gave us our cost of goods available for sale. Which was 22,082. Finally, we're going to less our merchandise inventory closing balance, which was 2460. Which got our final cost of goods sold. Which was 19. All right, everything after this is new territory. So what we determine once we know our net sales and our cost of goods sold is we will determine our gross profit from sales. So our gross profit from sales is 12,338. So now we look at our operating expenses. Now, it doesn't matter if it's perpetual or periodic. What we do is we break our operating expenses into two sections. We have our selling and our general and administrative. So now we're not worried about the cost of the inventory or the product or the retail value of anything. We're only worried about, when I mean by overhead, I mean like the cost of turning the lights on in your store. It doesn't affect your inventory cost, but you still need to pay other bills. You have staff, you've got offices, you've got accounting costs. And you can break it down between either selling or you can break it down between selling, or general and administrative. So we're going to start with our selling expenses. So this part, the way we break it down, will be our first section. Let's have a look and see what is on our trial balance. So I'm just going to go through here We're only worried about we have our sales, salaries, expenses. We have a selling space. We have store supplies, advertising. Office would be administrative. Office space would be administrative, and office supplies would be administrative. So do you see how these expenses can be broken down into... Am I on the wrong one here? Sorry. Oh, right here. My mistake. Okay. We have, just following along, double check this. Sorry, we have office and telephone. So these are actually broken up. So we have an office, which would be administrative, selling, the store, which would be selling. And we have two wages expense. So we have an office, which would be our administrative, and our selling. So when you're doing this, all you need to worry about, the only thing you'll need to worry about is whether it be perpetual or periodic, is just what is overhead and what is not. So any overhead, is it selling or is it general and administrative? So what we're going to do here is just put our two sales one in. So we have our telephone expense for our store. And our wages expense for our selling. So we've got stores 340 and 8,000.
What about the deposition expense delivering trucks? Are we considering this as selling expenses as well?
The delivering trucks, the transportation?
Yeah, deposition expense delivery trucks, 611, code 611.
Sorry. Oh, right here, the 1-1. Oh, we have an interest expense too. Okay, so interest. Yeah, so this delivery would be for sales. If it was like,
Office?
yeah, depreciation for office, then yeah. So yeah, good catch there. So we have one more here. Thanks, guys. Depreciation, expense, delivery, truck, 640. $640. So now we have 8,980. So you can either write total selling expenses, or you can just sum it like that. And then we have our general and administrative. And we have two. So we've got our telephone and our wages. And I don't see any others, so. Interest, did you say? We'll get to interest in a moment here. Give me, yeah, right after that I'll show you where that interest goes. So we have telephone. And we have wages. Telephone for the office is $150. And the wages for the office is $4,900. And that brings us to our total operating expenses. $8,980. 14,030. Which would get us our profit slash loss from operations and that is 1692 loss. So this is pretty common. Oh, this is very common from our operations. So we do include another section, one final section. It's called other revenues and expenses. Other revenues and expenses. Our other revenues and expenses is a section that we use, and it's used for scenarios that have nothing to do with the operation of the company. So if you were to take out a bank loan, let's say I were to own this business, this John's Electronics, and I had a bank loan of $1 million and I was paying $50,000 a year in interest, right? I would have a $50,000 a year interest expense, but let's say you were to go buy the same business with cash and you didn't have a bank loan, you would not have a $50,000 interest expense. And so that $50,000 interest expense is nothing to do with the operations of the business. That only has something to do with my financial scenario. If I were to rent out a little office to someone in the back for a totally unrelated business, does that have anything to do with selling electronics? No. So like a rental income would be an example of other. So in other revenues and expenses, we put in all of the revenues and expenses that have no impact on the operations. This profit loss from operations is super important to see and have it be split up so we can see how the business is doing by itself. So in this scenario, we do have an interest expense. I think it's the only one. We have no interest income or anything like that. And it's for 130. And it finally gets our total loss of 1822. So in the last chapter, we took our balance sheets and we made them a lot more intricate and we classified our accounts. And now we've introduced inventory and we've basically classified our expenses. Regardless of the accounting treatment for a company, periodic or perpetual, so this part will depend on if it's periodic or perpetual, but from our gross profit and below, it will be the same. Our other revenues and expenses will do the same thing. We'll still split operating and general and administrative. So this
Depreciation expense where we will use like if it's like an office expense like depreciation for the furniture, we will put in the general and administration expense.
yes.
If
Yeah.
it is on the truck and the loading, like
If it's used to sell, so
so yeah, it could be
it'd be
on
sales.
like
Yeah.
operating expenses. The one more thing, the wages will go there. It will be deducted from the cost of goods sold, or it will be from the operating expense.